Welcome to another Sunday episode of Financial Markets Weekly by Succinct Information. Today, we'll cover a busy week that included key monetary policy decisions, the release of the US employment report including non-farm payrolls for January, and other important economic updates like the Eurozone's GDP and inflation. In equity markets, we got the latest quarterly results from technology mega-cap names. Let's see what happened and how markets reacted. The Federal Reserve hiked its target rate as expected by 25 basis points, to a mid-rate of 4 5/8, the highest level since September 2007. It was the Fed's smallest increase since its aggressive tightening cycle began last March. Officials recognize that a disinflationary process has started, and that inflation is decelerating. Yet, the Fed said it needs more evidence that the trend is not temporary, and signaled a couple more hikes in the coming meetings. Investors' focus is now on trying to anticipate when the Fed decides to pause this tightening cycle. Staying in the US, on Friday, the Labor Department released the employment report for January, with non-farm payrolls significantly higher than estimates. 517,000 new jobs were created, well above the 185,000 expected, confirming the strength of the job market. As a reference, the monthly average during 2022 was 401,000. Moreover, the unemployment rate fell to 3.4%, the lowest in more than 53 years, another sign of the tight conditions. Moving on to Europe, the European Central Bank also raised rates by 50 basis points to 3% for its refinancing rate, and left a hawkish sentiment, as it signaled a similar hike for March. The ECB president said that inflation was still far too high. Core inflation in the Euro bloc remains at an all-time high of 5.2%, while headline inflation eased to 8.5% in January, from 9.2% a month earlier. One positive update was the Eurozone's GDP print for the last quarter of 2022, which showed a 1.9% annualized expansion, better than forecasts, and defying recession signals. The Bank of England hiked its base rate by 50 basis to 4%, the highest since the 2008 crisis. The tightening cycle that started in late 2021 accumulated 375 basis points in 10 meetings so far. Although Governor Bailey said it was too soon to call victory in the battle against inflation, he said that unless new data shows persistently high inflation, the actual policy rate could be the peak. Let's see how currency and interest rates markets reacted to this information. The dovish comments by the Bank of England caused the British pound to decline 2.8% on the week, to 1.205, and the broad weakness in commodities pulled the Australian and New Zealand dollars lower as well. Overall, the dollar ended 1% higher, recovering some of the losses in January. The dollar index is still down by 8% from its late October high at 103 points. Benchmark government bonds ended the week mostly unchanged, with 10-year treasuries now yielding 3.5% and bonds at 2.20%. The biggest movers were British bonds or gilts, as yields across the curve fell sharply, by an average of 22 basis points, and the 10-year is now at 3.05%. Equity markets traded firmer, with technology stocks as the driver of returns. The S&P 500 index ended 1.6% higher, the Nasdaq Composite gained 3.3%, European indexes added 1.2% on average, with Germany's DAX leading the board, and finally, Asian developed markets finished marginally lower, with limited index moves. Technology companies like Apple, Alphabet, Amazon and Meta platforms reported earnings. Most disappointed, either with the actual report for Q4 or their guidance for the current quarter. Apple missed revenue and earnings estimates citing a strong dollar, production disruptions in China, and a slower macro environment, as the reasons for its first year-on-year revenue fall since 2019. Yet, the company posted a total profit of $95 billion last year, and shares still closed 6% higher on the week. Google's parent, Alphabet, also missed estimates with minimal growth in sales, due to weakness in the advertising market. Shares also gained more than 5%. Amazon had its slowest quarterly growth since it was listed as a public company, and net profits were barely positive. It offered a disappointing outlook, rising concerns about customers' tight budgets, and stricter expense controls by corporates. Shares added just 1%. Meta Platforms was the week's surprise and notable mover. It reported better than expected revenues of $32 billion, down 4% year-on-year, and a net income of $4.6 billion for the quarter, down 55% from a year earlier. It missed forecasts but delivered an optimistic outlook as well as increased its share buyback plan by $40 billion. It also committed to controlling costs, and targeted a reduction of $5 billion for this year. The stock jumped 23% to $186, its highest level in 7 months. In commodities, the broad Bloomberg BCom index fell by 4%, to the lowest level in 1 year. Crude oil fell 8% with Brent closing at $80 and WTI at $73.40. The European Union's price cap for Russia's exports of refined oil products starts today. Base metals also declined sharply, following weeks of strong returns, as the expected demand from China has not yet materialized. Copper lost 3%, tin dropped 8% and zinc ended 5% lower. That's all for this update. Please keep sharing this channel. Visit us at succinct.info to learn about our service. Have a good week.